Have you ever felt stuck wondering how to get started in commercial real estate? In this video, I'm gonna break down the 5 things that I would do if I was getting started today. I know that commercial real estate can be frustrating to break into. How do you find the deals? How do you analyze them? Well, I've been in commercial real estate for over 11 years. I currently own over $65 million in assets, and I run a mastermind where I help other people invest in commercial real estate and build a portfolio of these assets. So today, I'm gonna walk you through, step by step, what you should be doing. Step 1 is just define your niche. You need to narrow down what you're actually looking at so that you can focus and become the expert on that. And your niche can be anything from specific asset classes like office, retail, industrial, self-storage, multifamily, or it could be a specific neighborhood. That's actually the path that I took. I decided to start investing in commercial real estate in East Nashville where I could learn the neighborhood really well. There's so many different ways for you to actually narrow down your niche and focus your efforts when it comes to commercial real estate. When you're first getting started, it's incredibly important to do this because there's so many shiny objects out there. I know it's very easy to get distracted, but don't do it. Just pick something. You can always pivot later once you've learned enough about that asset class. Narrowing down allows you to build specialized knowledge, spot opportunities more easily, and really tailor your approach to that specific strategy. I promise it's going to make your life infinitely easier. So how do you go about actually choosing what niche you should focus on? First, just consider your background. Do you have experience as a residential real estate investor? Then maybe multifamily or self-storage would be the easiest path for you to take. Those asset classes are very similar to managing single-family residential homes, but they're larger, they're at scale. You can actually raise investment capital for these. Maybe you come from a background like a doctor or you're in e-commerce. Well, maybe taking the medical office route or industrial warehousing and distribution will be a better option for you because you actually have a background. You kind of understand how those industries work and what those tenant needs are. You could also just reflect on your cash flow goals. Do you need the cash flow today to replace the income that you're receiving from your W-2 job? Well, in that case, you're probably going to want to go with something that's a little more value add, that's a little more work intensive, so you can increase cash flow from that project. However, if you're more into wealth preservation or you want to really take advantage of appreciation, you might want to buy something that's a little bit nicer, on a corner, high visibility, a little more stable national credit tenants. There's so many different directions for you to take depending on what your financial strategy is. And at the end of the day, just assess your comfort level. How much risk are you willing to take? In terms of the lowest risk, you're probably looking at single tenant net leased asset deals, right? That's like buying a Starbucks or a Walgreens. These are national credit tenants that have phenomenal locations that are going to sign long-term leases. You're not going to really be able to increase the value of the property outside of what it naturally appreciates at, but you also don't have to worry too much about maybe vacancy or, will the property be maintained properly or not by the tenants. However, if you're looking to really increase value and create a lot of equity, which is what I did in my portfolio, you can go for something that needs a little bit more work. Maybe the property's distressed and it physically needs a new paint job or some, major repairs and renovations. Or maybe it's just run poorly on the operations side. For example, I just bought a 105 unit self-storage facility 10 minutes up the road. It's 72% occupied in a market where self-storage facilities are 90 to 92% occupied. We don't really have to do any physical value add to this property other than answering the phones and leasing people a self-storage unit that they are calling us wanting to take. Sometimes that's all it takes is just having an operational value add strategy. But if you combine that too with a physical value add strategy, such as new paint, new units, or expanding the buildings, you could really increase the value of the property. After that, it really just comes down to doing the research on your market. And this doesn't have to be incredibly complicated. It can be as simple as learning what types of properties are in demand in a specific area and why, right? If you're near an interstate and a railroad facility, there's probably gonna be a lot of industrial over there because they like to offload off of trains and quickly get onto the interstate to get to homes. Same with a medical district. It's pretty obvious to understand why all of the doctors tend to group together. If you're gonna be buying properties over there, you may be able to find something that's not currently medical use that could be converted to that. You also want to understand your economic drivers. In Midland, Odessa, Texas, it is all oil and gas, right? As long as oil and gas are doing well, Midland, Odessa is doing pretty great. However, in Nashville, it's much more balanced. We have a big educational center here. It's very healthcare oriented and focused. We have a burgeoning tech hub. There's a lot of variety of industry that helps Nashville continue to grow the way that it is. So go study those those dynamics in your market. Use tools like LoopNet and Crexy to see what is out there in the market. Go study the demographics. Figure out, is your population growing or is it declining? Are businesses moving there? Why are they moving there? So here's some actionable steps for you to take right now. Write down 3 niches that align with your background, interests, or goals. Identify a specific market area, a city, region, etc., where you will focus your efforts. Conduct basic research using tools like apartments.com or Crexy to better understand the deal dynamics in your area. Then create a simple spreadsheet just to track specific metrics. Price per square foot, cap rates, rental rates. Items like that really help you start to get a better picture of what the opportunity is within a market. And finally, start building your network. Go join commercial real estate meetups, build relationships with brokers, attorneys, CPAs, lenders, because those will all come in handy. Real estate is not necessarily about what you know, it's about who you know. So now that you've chosen your niche and your market, it's time for step number 2, which is master deal analysis. It's time for you to learn how to actually analyze these deals to understand if they're a good opportunity for you or not. Deal analysis in commercial real estate is absolutely critical because these are investments, right? So you have to understand what is driving demand for that property, why it's going to continue to cash flow after you buy it, how you're going to make sure that it cash flows after you buy it. It's all very important. Commercial real estate properties are based on the income that they produce, not necessarily just based on what the building next door sold. Mistakes in your analysis could be incredibly costly. Let's go over some key metrics that you need to understand to better analyze commercial real estate deals. The first one is net operating income. The NOI is basically the net cash flow from the asset before you pay any debt service from your bank. So this is how much net cash flow is going to be coming from a property. For example, if you buy a $1 million asset and it cash flows $70,000 a year of NOI, that's a 7% cap rate, right? You're basically getting a 7% cash on cash return if you paid all cash. This metric is very important because that's what all investors will look at to determine whether a property is worth buying or not. Because again, these commercial properties are really based off of the income that they currently produce and the potential income that they could produce. Next one is cap rate, like I just mentioned. A cap rate is essentially the cash on cash return that you would get if you were paying all cash for a deal. The reason that investors use this in commercial real estate is because everybody's capital stack, the sources of their income to buy a property, is totally different. You might pay cash for a deal, whereas I might bring 50% equity and get 50% debt, and the next guy may do 0% down with 100% seller financing. Either way, it still allows us to look at the deal with a very similar metric so that we can understand what the potential cash flow is for that opportunity. Then you have your cash on cash return. If you've been doing single-family residential real estate investing, you definitely understand what a cash on cash return is, but it's basically how many dollars are you getting back for every dollar invested. Finally, you have your debt service coverage ratio. This is a ratio that is critically important for your lender because they want to make sure that the project is making enough money for you to, of course, pay the loan back, but then also make some money. Funny enough, yes, the lenders want to make sure that there is room in a deal for you to make money because they know if you're not making any money, you're probably just going to walk away from the deal and not be very happy with it. So a typical debt service coverage ratio is about 1.25 times, which means for every $100 in debt, you need about $125 in net operating income. That makes the bank feel pretty comfortable with their position and make sure that you are cash flowing the deal. All right, now let's walk through the specific points that you'll be covering as you are analyzing a deal. First, gather all of the numbers. Get your rent roll, get your operating expenses, figure out what your mortgage payments are going to be. That way you can be as accurate as you possibly can when you're determining how much net cash flow you're actually going to get from these opportunities. You can use an underwriting spreadsheet, which will help you really pull all these numbers out. There's a link in the description below for you to download my free deal analysis toolkit that has the spreadsheet that I use for everything. So go grab that. You can also call a commercial property manager to better determine whether your operating expenses are high or low. That way, again, you can get a better idea of what it's going to be like to operate that property on a day-to-day basis once you take over. Then you'll input all of that data into your underwriting spreadsheet. The nice thing about these spreadsheets is that they take everything into account. You couldn't possibly do this all in your head. Or maybe you can, and I'm just an idiot. But that's a lot of information and a lot of numbers, so I highly recommend getting a spreadsheet to just help you do all of this. Once you have everything compiled into this spreadsheet, you're going to conduct what's called a sensitivity analysis. That's basically where you go in and raise rental rates a little bit or lower them. You increase your interest rate to see if that works, or you decrease the amount of money you put down, or maybe your vacancy increases a little bit. You're really testing the numbers to see what ends up breaking this deal. If the deal passes the sensitivity test and you're still hitting the return metrics that you want to hit on this opportunity, sounds like it could be a pretty good project. So from there, you'll make an offer and get everything rolling. There are some common mistakes that you definitely want to avoid though as you are going through and doing your underwriting. I cannot stress that enough. I like to be as conservative as I possibly can when it comes to my underwriting, because if a deal works and I've beat it up with the numbers, then that's a good opportunity. So I know that even if we hit another pandemic or something happens and the next Amazon comes along and destroys an entire industry worth of businesses, my commercial properties will still be able to do fine. So always double check the numbers and just start small. Start smaller with a deal. You don't have to go do a $15 million development for your first project. My first one was a $575,000 office building. Underwriting and doing these deals is just like working out. The more you do it, the better you get at it. So start small, make it happen, make it easier on yourself. Okay, now that you understand how to analyze deals, it's time for step 3. Build the team around you that will make these deals possible. Commercial real estate is a team sport. Nobody does this stuff by themselves. There's no way that somebody can know everything about architecture, engineering, underwriting, brokering, tax strategies, etc. It's critical that you start building this team early on because, like I mentioned earlier, they could help you find deals, make sure that the deals are actually good, and a well-rounded team will really help you mitigate the risk involved with these assets. They'll also help you save a lot of time. So who are the key members of your team? Well, first and foremost, a commercial real estate broker. I think that a commercial real estate broker is going to be basically the center of your universe when it comes to being a commercial real estate investor, because they can connect you with literally everybody else that we're going to talk about today, especially if they're good, because they've been around for a while. They've seen the people that do good work and do bad work. Commercial real estate brokers will help you find properties. They can help you analyze them. They can help you find tenants for them, and they can even sell it later on when you're ready to exit the deal. You're also going to want a commercial real estate specific attorney. Just because somebody's a real estate attorney doesn't necessarily mean that they specialize in commercial real estate. And since commercial real estate has its own lingo, its own clauses, its own structures in these deals, it's critically important that whoever you are working with on these letters of intent, purchase and sale agreements, leases, etc., they need to understand how all of that typically gets done, because every market's different too. So an attorney in New York may not necessarily understand how deals get done in Texas. A good attorney will help you mitigate your risk and think through all of the items that could potentially come back to haunt you later on, and hopefully try to head them off at the pass. You're also going to want a really good lender or mortgage broker as you're going through this process, because they're going to be giving you a lot of money. I would look at the lender or your mortgage broker really as a partner in the deal. They're bringing 60, 70, 80% of the capital that you need in order to close on this, and they're going to have a very strong relationship with you, hopefully, because they're going to have a lot invested in this deal. They really do want to make sure that your project is a success. So when they tell you, hey, the numbers aren't working, I would listen to them and try to figure out why they feel that way. You'll also want to find different lenders based on the types of mortgages that they can do for commercial real estate. Are you looking to own or occupy a space? You may want somebody that specializes in SBA loans. Are you just looking to be a normal investor? You don't want anything fancy? Maybe you want to look at traditional loans or CMBS loans. There's so many different types of packages out there depending on what you specifically are needing for your deal and how you want to have it structured. You'll want to find a good commercial property manager as well, somebody to keep the tenants arm's length and help you manage the day-to-day of your properties. You're not jumping into commercial real estate to buy yourself another job. You want somebody else to really run the day-to-day so that you can go find the next opportunity and build that portfolio of assets. A commercial property manager knows how to properly inspect the properties, plan out a budget for the year, and take into account all of the capital expenditures that will be coming up over the next 1, 3, 5 years. And finally, you're going to want a good accountant or CPA and a good contractor, right? You need somebody to help you prepare for your taxes and make sure that your books are good. And you're going to want somebody that's going to be there to do any of the renovations and get you estimates on any work that needs to be done for your property. That way you can just budget for everything on all fronts. So now that you have your team in place, it's time for step 4, securing financing for your deals. This can actually make or break the financials on a project, so let's make sure that we spend some time here. One of the most beautiful aspects of commercial real estate investing is the ability to use leverage, right? I'm borrowing money from somebody else to make money, which means I don't have to put up 100% of the capital myself. But it's critical that you get this point right, because it's going to determine if the property cash flows flows, how you'll weather economic downturns, and whether you're able to scale a portfolio or not. Yes, 5 or 10% down can look pretty attractive until you start to realize how high that monthly nut is that you have to crack in order for you to make any money. There's a reason most banks actually like for you to bring 20 to 25% down in your projects, and that's because, one, of course, it de-risks the deal for them, but two, it de-risks it for you. It means that you have enough equity down so that your monthly payments are not so absurd that the project just doesn't make sense. Now, we won't be diving into coming up with a down payment or raising capital from investors, because I have a lot of other videos on that. Check out this one here. So we'll just assume that you have the capital already. Now, there's several different types of financing options. Let's start with traditional bank loans. These are the gold standard of commercial real estate loans. 9 times out of 10, it's probably what you're going to come across. You'll need to put down around 20 to 30%. These will typically have competitive interest rates, and they're more often than not going to be coming from more local or regional lenders than your national ones, right? Don't go calling Bank of America because they probably wouldn't be fun for you to deal with. Go call that local bank that has 5 branches because they understand the local market, and those banks actually have a bigger portfolio of localized commercial real estate properties than the big banks do. If you own a business and you're looking to own or occupy the commercial space, you could take the SBA loan route. These will typically have slightly higher interest rates, but you can put down as little as 10% in order to make these happen. If you're wanting to get higher leverage, take a little bit more risk, you might want to go with a commercial mortgage-backed security, a CMBS loan. These loans are non-recourse, which is pretty nice, meaning you're not having to personally sign on the loan, and they have competitive rates, but they'll also have very strict terms in order for you to qualify. Not every commercial property is going to qualify for a CMBS loan because they're really looking at the property as collateral. So you got to think, what kind of property would they want to have to foreclose on? Make sure that you're reading the fine print on every type of loan document that you're doing so that you fully understand what you're looking at. You could also do a joint venture or an equity partnership where you go and raise the capital and partner with other investors in order to do this project. These are great ways to do it because, one, you don't have to have any capital, you don't have to have a balance sheet to do anything. My first development project back in 2015 was a 42-unit townhome development that was around like $6 or $7 million to build. I didn't have that money, and I definitely didn't have the balance sheet. And if I had signed on that loan, the bank probably would have raised the interest rates. But because I partnered with a developer who had the background, the track record, the experience, the cash, and the balance sheet, I got 10% of the project just for working on it, putting the deal together, and spending about 2 years on that project without having to come out of pocket for any cash or to sign on a loan. Pretty nice way to do it. Very great way for you to scale. All you have to do is become the expert on finding deals and operating them, because there's a ton of people out there that have a lot of money that don't have the time to go find and operate deals like you do. And finally, getting more creative with the financing, use the seller as a bank. Go for seller financing with these deals. This can be a pretty attractive strategy for both you and the seller. One, you could probably get better terms on the loan just because it's a seller and not a traditional bank. But for the seller, they can actually keep a monthly mortgage note coming in instead of just selling the property, paying taxes, and having to walk away. If you ever miss a payment, they can foreclose on it and take the property back. I love doing seller finance deals because it's typically a win-win if you structure it right. I've got an entire video diving into creative financing strategies, so check out this one here. Highly recommend getting an attorney involved to help you through this process. Don't make the mistake that a lot of people do, which is just sign a document because they think, oh, it's standard. Here's the thing, most banks will tell you that their loan docs are standard, but they will still negotiate them because they want to get the deal done. And some of the stuff that they have in those documents, you should never agree to. So make sure that you have an attorney that is on your side that understands how these are done to review these deals and make sure that you are protected. Okay, now that you have financing in place, it's time for you to start small and scale fast, which is step number 5. You've chosen your niche, you've mastered deal analysis, you've built your team, and you've learned how to put financing together. Now we get to do the fun part, right? Which is go out, find deals, put them together, and start building a portfolio of these assets that's gonna give you the $10,000, $20,000 a month in cash flow that you want, passively, of course. It's gonna help you build the generational wealth and allow you to really travel and do all the things with your life that you want. But you have to build a portfolio of these assets first. It's critically important, though, that you think about that and you start small. Yes, I'm over $65 million in assets today, but I started off with a $575,000 building with 2 investors 6 years ago. I've slowly built it up over time, and I wouldn't do it any other way. By being intentional about the types of properties that I bought, starting small, getting the experience, I allowed myself to not get over my skis. It is very important in this business that you don't go get something that you're not ready for yet, because all it takes is one deal to bankrupt you. So make sure that you're taking small steps, and at the end of the day, those steps will add up. So what are some strategies for starting small? Well, just focus on smaller assets, right? Maybe start under $1 million. Go look in your market and see what is available for sale under $1 million. Partner with experienced investors. I would not be where I am today if I didn't bring in people that had been there, done that made the bank feel good, they made the investors feel good, and honestly, their insight helped pull all of these projects together. The great thing about having experienced investors is that you can borrow their track record. That is probably the most valuable thing that you will ever get out of working with anybody else. Borrow their track record. My first syndication, which was a 12,000 square foot office building that we bought back in 2019. I had a partner on that who owned over 3,000 apartment units at the time. It was my first syndication, first time really raising capital officially. Do you think any of those investors would have given me the money to do my first deal? Probably not. But they saw that my partner had so many units, he could just pay cash for this deal if he wanted to, and was there backing me up, which made them feel really good about giving us money to do it. Get creative with the financing. Find a way to not have to bring any money to the table. I've done plenty of deals where I brought zero to the table. Find a way to get the seller to carry back a portion so you can only bring 10% down. They lend you 10%, and then the bank gives you 80%. There you go. You've done something creative. There's so many different ways for you to look at it. I just recommend think outside the box. My favorite phrase is by Miles Davis, which is you have to know the rules before you can break them. And I don't think that there's anywhere that applies as much as it does in commercial real estate. Once you've gotten your start, you gotta scale fast. And there's a few different ways for you to actually do that. One, strategic partnerships, right? Go out, borrow other people's balance sheets, borrow their money to go and build more properties faster. The bigger of a portfolio you have, the easier it is for you to continue to scale. It's like a snowball effect. The other thing is leverage 1031 exchanges. That allows you to really grow quickly without having to worry about paying taxes to the government. For example, I bought a 1.7 acre piece of property right down the street that my partner and I got for $630,000 back in 2021. We got it rezoned. We just sold it for $1,575,000. Not a bad flip, but we would have to pay several $100,000 in taxes to the government if we wanted to just cash out. Instead, we're doing a 1031 exchange into a self-storage facility where we're gonna cash flow about $20,000 to $30,000 a month. That is after all of our payments, net 20 to 30 grand a month. I would rather take that than pay several $100,000 to the government and then figure out whatever else I wanted to do with my money. That's how you can really scale fast in this business. Build operational systems and make sure that you have the right team to help you manage this. Like I mentioned earlier, don't manage your properties yourself. Hire a property manager to do that for you. Don't lease the properties yourself. Hire a commercial real estate broker to do that for you. It allows you to focus on what you're good at and only what you can do, which is finding the next deal. So if you want to become a master at analyzing these deals to make sure that you can start small and scale fast, click that link in the description below for a free download of my deal analysis toolkit. It will help you get started way faster and cut that learning curve down so that you can start analyzing deals today. So there you have it for the 5 things that I would do if I wanted to get my first commercial property this year. If you want an idea of what could actually be the best commercial property for beginners to own, check out this video here.